I'm just going to give everybody a minute to join us, and we'll start our webinar right away. Okay, I'm going to assume that everybody that's dialed in is able to connect. And once again, welcome. My name is Chris Cullen. I'm a Senior Vice President and Head of ETFs for Brompton Funds. Yeah, I'm very pleased to be here today with Mike Clare, who is one of our Senior Portfolio Managers, and he's been with Brompton for over 10 years. Mike specializes in equities and equity covered call mandates, and he's specifically the lead portfolio manager for our equity covered call product that's focused on North American financials, ticker BFIN. Eric is the president and lead portfolio manager for Flaherty and Crumrine. Flaherty and Crumrine we've worked with for just about 20 years now. The firm has been active in the U.S. preferred space for 40 years plus now. So a great wealth of experience in credit, and specifically in financials focused credit. The U.S. pref market is very heavy in preferred shares. So with that brief introduction, I'm going to just launch into just a discussion today. I'm going to ask a few questions. Eric and Mike will take the questions, and we will get a lot of insight into the financials area. So just to start, Eric and Mike, maybe we can start with explaining just the differences between the approaches for a credit investor, such as yourself, Eric, and an equity investor in the financial space. Eric, why don't you start off?
Yeah, sure. Thanks, Chris, and thanks everyone for joining us today. As Chris mentioned, we focus mostly on the credit side of the equation here, although they're quite complementary, as you'll hear, I think, as Mike explains his viewpoints as well. As a credit investor, though, for the most part, we care about the balance sheet. Obviously, earnings matter, and earnings eventually make their way to the balance sheet. But for the most part, what we care about is the amount of equity credit that is supporting the rest of the capital structure, whether it's prefers or subordinated debt or senior debt on up all the way up to depositors. So from a credit perspective, we think of the equity and the earnings power of a particular institution as really being that buffer between ultimate losses to a credit investor. So if we have an economic downturn or we have an increase in loan losses in a particular bank, the equity is there. Usually that rolls through earnings, lower earnings, but never really reduces the amount of capital involved in that bank. And that's really the buffer that we're looking for as a credit investor. Whereas the equity investors are going to care a lot more about the actual earnings number from quarter to quarter. So we don't mind earnings fluctuations. Of course, we want banks and other financials to earn positive net income. At the end of the day, you need that even as a credit investor. But what we rely on really is that buffer, whether it's in the form of capital already on the balance sheet or ongoing and recurring earnings that come through on a quarterly basis. The other, I think, complementary factor, but one I'll point out as a credit investor, is really the regulatory environment. The regulatory environment matters a lot to us as credit investors. It's a set of procedures and processes to try and make sure you have enough transparency to evaluate these institutions. It's also trying to set minimum levels for risk assessment. You go all the way to some of the risk testing that goes on. And all of those things are really additive to what we do as investors on the credit evaluation process. So the regulatory environment really is important, and really another layer of risk reduction is kind of the way we think about it from the credit standpoint.
Yeah, that's a great overview, Eric. Thank you very much. And we're going to get back to some questions on the regulatory environment in just a moment, but I'd like to pass this over to Mike. Maybe, Mike, you could differentiate the type of work that you do in the financial services area.
Thanks, Chris. And thanks, Eric. I think it was a good overview of obviously the importance of capital and the balance sheet to the financial sector, which as an equity investor, we find equally as important. But I also think from an equity investor standpoint, it's also important to look at particularly when looking at the banks and the insurance sector, look at profitability as well as valuation. And so one of my favorite metrics to look at from when looking at financials, obviously, like profitability before provisions. This is looking at the base profitability levels of say, a bank before taking into consideration the impact of the credit environment that we're in. So just looking at pre-provision, pre-tax net revenues of a bank. And I think this is, from an equity investor standpoint, is equally important to capital because it really shows the ability of a bank to rebuild capital when you go through a cycle and have sort of increased credit losses that may temporarily impair the capital. I think is one of the reasons that the Canadian banks did really well coming out of the financial crisis, which is now 15 years in the past, is that base profitability level is pretty good, and that's sort of why the Canadian banks really weather that storm better than the U.S. banks in a lot of cases. Also, from our perspective, looking at our North American financials fund, it's not just about the banks. I wanted to highlight the importance of looking at diversified financials as well. So things like fintech, asset management, exchanges, data providers, and so forth, which I think can provide good balance in the portfolio. It helps balance the risk versus return of our portfolio, and is a place that we can invest, particularly in times of the market like we've seen the last couple of years, where banks have been challenged for various reasons.
Okay, fantastic overview, Mike. Thank you for that. Eric, I'm going to go back to you just to maybe continue the discussion on regulatory capital. And what I'm thinking of specifically were early 2023 turbulence in the banking sector when we saw a number of regionals come under stress and fail in some cases, and also just a large international bank collapse. How do I connect that all if regulatory capital is sufficient, but we see bank failures?
Yeah, Chris, early 2023 was kind of a unique circumstance, and we discussed this all the way through the year that we really thought this was relatively isolated, that the broader banking system, North American, European, was actually in very good shape. You're right, capital ratios in a number of these banks were in very good shape, and in some cases historically very high levels, mostly because of the regulatory environment that's evolved over the last decade for sure, coming out of the financial crisis, but even more so in the last decade, to really strengthen those regulatory capital ratios. So the reality is higher interest rates, notably in the U.S. Through the Federal Reserve raising rates, but we've seen it globally, right? Central banks raising rates really exposed some problems at specific banks, notably the asset liability mismatch that some of these banks were on their investment portfolio, low coupon, long duration investments, and then as it turned out also in their loan portfolio, a lot of low coupon loans that have a lot longer duration than most people expected or even realized. But I think as it turned out that those were very bank specific, and there was those mismanagement, I guess is how we would refer to them. That's part of credit, and it's part of equity analysis, is relying on management's discretion and decision making and risk management processes to really make sure that they're not taking outsized risk. The other side of it really, I think, is that the financial sector continues to be a confidence-based sector. And the reality is confidence is incredibly important. Most banks fund themselves with deposits that in today's world, with all the electronic movement of money, it's really easy to move deposits. And I think that's the other thing that 2023 really proved out, is that when deposits start leaving banks, it can be pretty rapid. The good news is I think that banks have really taken steps to address what was the immediate cause of the early part of 2023. For those banks that didn't have the large asset liability mismatch, they weren't mismanaging the balance sheet. They were taking steps to make sure that the deposit base was shored up, the confidence was restored, and that was really critical to stemming the losses to a relatively limited number of small institutions. Even in the case of Credit Suisse, which is the international bank you referred to, that turned out, again, the proximate cause of that failure was a run on the bank, which again is really confidence driven. The regulatory capital ratios were actually fairly healthy, but the deposits were leaving the bank quite rapidly. So what we've seen now, though, is several quarters. We're almost a year past the first of those problems, and what we've seen is a lot of shoring up of the deposit base, and continued focus on regulatory capital, and then earnings along the way, right? They've been producing positive earnings. Loan loss provisions have been very much as expected, and really no other, nothing else hiding in the closet, if you will, has really been exposed. It's not to say all banks are created equally, because they're definitely not. And there are different levels of risk depending on how the bank has been managed. There are still banks out there that have a more unrealized losses through the asset liability mismatch than other banks. And that's really where you have to dig down on each individual bank and understand the risks that they're taking and how they're shoring up that risk or mitigating that risk on the full balance sheet in total. So that's really how we focus on it. But broadly speaking, the banking system's in very good shape, and fortunately those losses were very limited in number.
Okay. So just to me, that's a surprise that that asset liability mismatch kind of came out of this rising rate scenario. That the expectation in my mind, as I'm a novice compared to the two of you, would be that would be positive for banks. But on the equity side, Mike, how are you finding the impact of rising rates, and how's it doing for their core business, other parts of their other divisions like loan growth, net interest income, that kind of thing?
Yeah, thanks, Chris. I think broadly speaking, for the banks, and just thinking about the banks in terms of North American banks here, I think to understand, the core bit, obviously the core business of a bank being earning a spread on, net interest income. I think to understand sort of where we are today, it helps to look back at the last 3 to 4 years, starting with the COVID crisis. And obviously we had a pretty substantial stimulus in response to that COVID crisis, both at the fiscal level with money essentially being deposited into people's accounts. And then at the same time, you had QE, which basically resulted in extremely rapid deposit growth and also just broadly speaking, balance sheet growth across the banking sector in North America. So first of all, you've got point number one, asset growth went up, balance sheet growth. And then as we went into 2022 and into 2023, we saw a rate hiking cycle, which initially drove margins higher. So now if you look at the banking system, the large US banks, their net interest income is, for example, 28% above 2019 levels. It's a little higher at 45% for the regional banks. Canadian banks are about 23% above 2019 levels. So there was a period, which I would call, where banks were able to essentially over-earn a little bit because of bloated balance sheets and the initial rise in rates. But eventually, as the rate cycle continued, you started to see more aggressive repricing of deposits. And so deposits started to actually reprice faster than the asset side of the balance sheet, which actually started to pressure net interest margins. And then at the same time, you had the reversal of QE. So QT led to some of the unwind of that excess balance sheet growth. So broadly speaking, where we sit today, we've seen some deposit outflows. I think that's mostly done. When looking at the broader bank system as a whole going forward, I think QT is a lot closer to the end than we are to the beginning. The economy is still reasonably strong. The consumer balance sheets are still reasonably strong. So we do expect some loan growth in 2024, but it's probably going to be muted. So something in like the low single digit range, but what has the potential to surprise more to the upside than the downside, in my view. Rates now, we've essentially gotten to the point where I think we can take more rate hikes off the table. If you look at the Fed's favored measure of inflation, the core PCE price index, which is the data that came out last week, showed over the last 6 months, that's down to 1.9% annualized. Over the last 3 months, it's 1.5% annualized. And so now I think you can take rate hikes off the table, which that alone I think is positive for the banks. It reduces uncertainty. But now the market's also pricing in cuts over the next year or the next couple of years as well. So currently in the US, the market's pricing in somewhere between 5 and 6 25 basis points cuts. You look at over 2 years, you see the potential for upwards of 200 basis points of cuts. And so now that we've got essentially rate hikes off the table, the potential for cuts coming over the next year, the couple years, I think the deposit repricing issue has slowed down quite a bit. If and when we do get these interest rate cuts, it may take a couple of quarters for that to show up in lower deposit rates. But regardless of that, I think net interest margins are probably likely to bottom in the first half of 2024. Banks, I think you still see a tailwind from fixed rate assets repricing higher. And so you put this all together, we do expect net interest income to be down across the banking sector this year, so something in like the 4 to 5% range. But we're still well above 2019 levels, despite the fact that bank stocks, broadly speaking, trade around 2019 levels. And we also could be near an inflection point where you could see sort of Q4 net interest income above Q1 levels. And we could see an upward bias in a more aggressive hiking scenario, although I would caution against the most aggressive scenarios because that's more likely to come along with a recession, which would be negative for banks. But in the soft landing scenario, I think cuts sort of in 100 to 200 basis point range over the next couple of years is pretty good for the banking sector as a whole. And then I think importantly too, the market starts to look out from like an equity perspective, the market starts to look out to 2025 numbers, which should be starting to look a lot better relative to 2024. So you should see the market start to price in a better 2025 as we progress throughout the year.
Okay, sounds like quite an attractive future lies ahead, I hope. I hope for my own investments and for our firms. So as far as news flow goes, Eric, something that I'm seeing across my screen quite often is just worries about commercial real estate and financial sector's exposure to that area. Can you kind of give us some insight into how you think about this?
Yeah, commercial real estate's been a common topic recently, and particularly coming out of the issues that the banks had last March, April. Because I think it was the one item that people were concerned might be the next shoe to drop, if you will. The reality of CRE is commercial real estate's a really broad definition, right? And it covers a lot of different types of lending. The one that we focused on the most really is office property, because particularly coming out of COVID, as everyone's aware, all the work from home movement, companies reducing footprints, particularly in the large cities like New York, San Francisco. And what you're ending up with is occupancy in these office buildings being much, much lower than expected. And it's really just this direct reaction to COVID, or evolution, if you will, to the working environment. But as kind of what we discussed earlier on the mismanagement side, it's really important to dig in bank specific, because most banks in our universe that we're investing in, the office CRE, which we think is the highest risk exposure, is generally in that 1 to 3% range of total loan portfolio. The banks that have what we would call a higher exposure might be in the 6 to 7% range of total loan portfolio. So in our universe, we think, one, the exposure isn't that large, and then two, you dig in and think about, okay, what types of property, what's the diversification, both in terms of types of property, location of that property, is it national, is it local, where's their exposure lie? And then lastly, really what we've focused on is the loan to value. And what you find is that most of these banks have been very disciplined in their underwriting process. Loan to values are generally speaking between 50 and 60% of the total loan value, which gives them a lot of cushion, especially if you think about that on a portfolio level, to absorb whatever losses end up coming through CRE. There's no doubt CRE has had some headline grabbing transactions, right? Where buildings have traded at 50% of their appraised value, for example, but those really have been relatively one-off cases. And it really boils down to, where does that debt live? And for the most part, in our universe, we don't think much of that debt lives on the balance sheets of the banks that we're looking at, even down into the regional and community bank. Now, there is exposure. I think if you get down far enough into the small community bank area, for example, there's going to be some localized and maybe concentrated exposure, but that's really not the universe that we concentrate on. And broadly speaking, especially if you go GSIBs to diversified super regionals and even down to the regional banks, it is what we think a very manageable exposure. And as we talked about earlier, we think it's largely an earnings event. What it's meant is higher provisions against potential defaults or loans on these loans in the future. But again, at the end of the day, the actual write-offs are likely to be relatively modest. So it's really a matter of banks provisioning. Are they provisioning proactively? Are they covering these potential losses and taking a conservative approach towards it, which has, hurt the earnings stream? But long term, we don't think that's a large exposure. So it's headline grabbing, but you really have to dig a lot deeper into individual banks' exposure on CRE.
Okay, great overview. Thank you very much, Eric. Mike, let's stick to real estate and something that's in the news quite a lot in Canada anyways, is the housing market. Can you give me your outlook for Canadian financials just in that context, please?
Yeah, thanks for that question. I think obviously you can't talk about the Canadian banking sector without touching on the housing market. I think one of the key differences between the Canadian economy and the US economy when it comes to rates is Canada tends to have a lot more sensitivity to interest rates. And it's because I like to say everyone in Canada who has a mortgage has a variable rate mortgage. It's just a question of whether it reprices month to month or over 5 years. Obviously, the most popular mortgage product here is the 5-year fixed mortgage. That differs quite a bit from the US, which has consumers that have access to that wonderful 30-year fixed mortgage. So obviously with rates moving up the way they have, that has pressured the housing market here. And as we continue to see renewals with, today, obviously someone with a mortgage that was last renewed in 2019, getting repriced to a higher rate in 2024, assuming they had a 5-year mortgage, that's going to come at a higher rate today and a higher payment. Obviously, that's going to continue to weigh on housing prices. But we really don't see it doesn't really become a bigger issue until 2025 and 2026, when we start the 5-year mortgage starts to lap the 2020 to 2021 vintages, where we saw sort of peak pricing in the housing market along with trough rates. Now, at the same time, the market in Canada is currently pricing in somewhere between 4 and 5 25 basis point cuts from the Bank of Canada this year. And again, similar to the US, upwards of 200 basis points of cuts over the next 2 years. And so if those cuts do materialize, then maybe those renewals in 25 and 26 don't become as big of an issue as people think they will. At the same time, we've had pretty rapid population growth in Canada, which is driving this ongoing demand for housing. Supply can't really keep up. So that has supported housing prices to a certain extent. And I would note too, historical loss rates on housing in Canada have been extremely low. Recoveries tend to be high, even with the prospect for higher payment rates as consumers go through the renewal process. Incomes, broadly speaking, are up as well. And so really the key risk is the employment market. So we'll be on the lookout for potentially rising unemployment in Canada, which could potentially make the issue worse. But as long as the employment picture stays okay, we end up in this soft landing scenario. Maybe the strength of the US economy helps prop up the Canadian economy as it has in the past. I think broadly speaking, the Canadian banks will be okay. We'll continue to generate attractive returns, like return on equity in the low teens. Capital levels are very strong, remain at record levels. I think the banks have already, broadly speaking, provisioned for a mild recession. So if we don't end up in a recession, then there's potential outperformance there. But just comparing the Canadian banks to the US banks, I think some of the factors that we look for generally support the US banks over the Canadian banks at this point in the cycle.
Okay, thank you so much for that overview, Mike. Let's just shift to another major geography for Eric. Can you give us a little bit of a sense of what's going on in Europe with banks?
Yeah, sure, Chris. Our market we really do think of as global. So it's US, it's Canadian, also all the European banks, Australian banks, et cetera. So we really do look at the global market. And a couple highlights, I guess. One is I would say the European banks, broadly speaking, first of all, we're focused on the largest European banks, United Kingdom and other European banks. And broadly speaking, profitabilities remained pretty good. Now, the European banking system is a little bit different, particularly notably than the US in terms of just the way it functions and the services it provides, right? The US notably has one of the largest capital markets in the world, and companies utilize capital markets in lieu of what in the European bank space, you see a lot more direct lending that stays on the bank balance sheet. So broadly speaking, you tend to see much larger balance sheets, but they also have relatively stable funding, also deposit funded for the most part. But when you get down to the mortgage market, for example, the mortgage lenders are keeping a lot of that on balance sheet, whereas in the US, so much of it gets securitized into investment products. And so, the space in general has it just functions a little bit differently, serves a little different role. But broadly speaking, some of the same trends are the same, which is profitability has been good. Loan losses have been historically quite low, and capital has remained very solid. They really didn't have, for the most part, they didn't really have the deposit issues that the regional banks had. Although, obviously, to be fair, Credit Suisse is not a U.S. bank entirely, but it's also more of an investment bank than it is a traditional commercial bank. And I think there's definitely an important distinction to draw there. The other thing I'll mention just broadly, I think this really applies to all the banks that we're talking about, but Mike alluded to it a little bit earlier, but the rate cuts that are potentially coming are going to have a real effect on almost everything we've talked about here today. The asset liability mismatch, which is unrealized gain losses. The mortgage rates in the US, mortgage rates are already lower by 100 basis points from their peak, over 100 basis points. And as you get into commercial real estate, for example, the biggest issue with commercial real estate has been the refinancing, right? A lot of those loans are similar to what Mike mentioned for mortgages, 5-year loans, and all of a sudden they're reaching that repricing time point when market values have changed and interest rates have changed, et cetera. So the rate environment that we've seen already, treasuries in the US down over 100 basis points in the last 2 months, and the potential for Fed cuts that Mike explained, both in the US and globally, are going to help ease all of those pressures that have been really building up throughout 2023. And that's going to apply to the European banks, the Canadian banks, and the US banks, kind of within their jurisdictions, depending on how those rate cuts come about. I think any rate cuts from here, whether they're slow or fast, are going to really accrue benefits to the entire financial system.
Okay, great. All right, we've covered the whole globe. Mike, why don't you give us a comment on regulation and what its impact, just developing regulation impacts financials in your world?
Yeah, obviously Eric alluded to it, the regulatory environment for banks and the financial sector broadly is very important when analyzing the sector. Now, there's obviously been a trend over the past decade, well, essentially since the financial crisis, towards increasing capital requirements, and the past year and outlook for 2024 is really a continuation of that trend. So, looking at Canada, OSFI, they raised the domestic stability buffer for our banks here twice over the past year, so that's now sits at 350 basis points versus previously 250. Now, they opted not to raise it again in this past December, so we think they're likely done, and minimum capital levels for the Canadian banks will sit at 11.5%. But we are seeing some new regulatory rules around certain risk areas. So there's been some attention towards these negative amortization mortgages in Canada. That's when consumers have these variable rate mortgages with a fixed payment. So OSFI's done a few things around the margin in terms of like changing risk weights, which serves the purpose of increasing capital requirements for those products. Nothing too significant, but it should help support the broader system more generally. And then they're also looking at certain portfolio level limits for these types of mortgages for the banks as well. In the US, the big news on the regulatory front is this proposed Basel III Endgame rule, which, as it initially came out, would see for the large banks in the US potentially higher capital requirements in the range of 20 to 40%, which would be quite punitive. Now, it's become, I think, increasingly clear that the final rule, when it comes out, will be watered down substantially. For example, like Powell at the Fed reportedly he wants consensus on this rule. So I think it'll have to get watered down to get that consensus. A lot of the GSIB management teams on their conference calls are telling us that it's going to be lightened. There's been pushback from both sides of the political aisle. And so, I'm not gonna forecast where this rule is going to come out, but I think it's reasonable when sort of modeling the banks look at a rule that has about half the impact in terms of capital requirements. You could see an average maybe 15% uplift to risk-weighted assets or capital requirements among the U.S. banks. And importantly, I think that opens the door to increased buybacks in the space. I think a lot of the banks have been conserving capital just in anticipation of these rules. But if you look at a potentially watered down rule, then the excess capital numbers for the U.S. banks can grow quite substantially with new capital generation over the next couple of years. So, for example, Morgan Stanley was out with a report this morning showing 2025, they expect essentially across the large GSIBs and some of the larger regionals in the US, a buyback yield of upwards of 9%, which on top of the dividend yield could drive 13% total shareholder return. So I guess it's sort of wait and see what happens with this new rule there, but potentially a positive tailwind for the sector if some of the rules do get lightened in the final rule.
Okay, great. Thanks for the comments. Eric, one last question just before we go into the Q&A session. We talked quite a bit about banks today. Insurance companies are a pretty important number two in the portfolios that you manage. Can you just highlight some of the main differences between when you look at banks versus insurance companies, and you put it in the global context?
Yeah, sure. Insurance is an important sector, and while there are some similarities, I think the differences are really distinct, notably coming out of 2023. Insurance companies, if you rewind back to the very low interest rate environment that we were in for so long, insurance companies were really struggling in that environment because they had investment portfolios, which are such a large component of what they do, investing at lower and lower yields. And they had the liability side of the balance sheet, which is where all their policies are and risks lie, that were getting priced at lower and lower discount rates, which basically means the liabilities are bigger. So they were kind of getting hit from both sides. And so when we started to see the Fed in the US raise interest rates, and globally as well, particularly outside of the US where we have a lot of negative interest rates, when those things started to reverse, those were really positive developments for the insurance industry. So insurance companies take in premiums on an ongoing basis. They generally take those premiums and invest them in investment portfolios and earn the carry, if you will, or the float, as it's referred to oftentimes. And higher interest rates in general mean higher reinvestment rates on new money, and also means some easing of the pressure on the liability side of the balance sheet, which is pressuring capital ratios. So everything that was pressuring them 5 years ago has in 22, 2023 really started to unwind and has really improved as Mike alluded to earlier, the spread in effect that they're able to earn has really eased up. Other notable differences, I think the most obvious one coming out of 2023 is that insurance companies are not deposit funded. They are generally funded via equity and debt, or hybrid securities and the like. But the capital markets, for the most part, in addition to shareholders, are funding those. And then obviously, as I mentioned, they have ongoing premiums and ongoing claims. The insurance companies have struggled a little bit with worldwide events, weather events, notably in the P&C sector, and that's definitely been a topic. Car insurance companies have really struggled. All this new technology that we all love in our cars means very expensive repair bills, and the insurance industry has been having to adjust to that, versus premiums versus deductibles and underwriting process. So it's been a bit of a transition, but through all of that, what I would say were very challenging markets, the insurance companies have continued to be profitable, and the change in interest rates that we talked about has really been beneficial, and I think a real source of relief for most insurance companies coming out of what was a very long period of declining and ultimately very low interest rates. So, that sector continues to be pretty attractive as well, and just different profile. It is important to remember insurance companies do a lot of direct lending, and particularly in the low rate environment, that was becoming more common because they were looking for returns that they couldn't achieve in the investment portfolio. So when you talk about CRE underwriting or direct lending for direct real estate or other types of products, they are definitely involved in those markets, and generally as a direct lender or syndicated lender and those types of things. So some of those risks that we talk about in the banking sector definitely apply to the insurance company, and you have to be on the lookout for those things within the portfolio, both the investment portfolio and the loan portfolio. But broadly speaking, I think the insurance companies have done a really fantastic job of managing through a low rate environment and are now coming out the other side of that and gaining the benefit of that.
That's great, Eric. Thank you so much for that overview. I'm just going to put it out there for our audience to ask some questions. If you'd like to submit a question to Eric or Mike, please use the Q&A function in your Zoom control bar. Just click on it. It should be right at the bottom, or at least somewhere along the edge of your screen, depending on how your screen's set up. You could also, if you choose, send an info@bromptongroup.com email, and we'll get your question and try to ask it right now. Just as we wait, Mike, you want to give us just a 30-second overview on diversified financials? It's something that we didn't quite get to in our allotted time here today.
Yeah, we've talked a lot about the banks, which obviously are pretty important within the broader financial space, as well as a bit on insurance. But I think, as an equity investor in North American financials, I do think having some diversified financials in the portfolio does act as a good support system for the broader portfolio, particularly during periods where maybe the banks are underperforming, as we saw over the past couple of years. And so we've looking at just some of the different subsectors, I think like exchanges have done pretty well with higher rates, with more rate trading and increased volatility, particularly across fixed income and currency markets. Fintechs broadly have been challenging for the most part outside of the big Visa and MasterCard. P&C insurance, Eric touched on it a little bit. I say on the P&C side, like, don't bet against pricing power. I think a lot of these companies have been able to pass along the higher losses in terms of higher premium rates. I know I've seen it in particular with higher auto insurance premiums, particularly over the past couple of years. Insurance brokers have been a source of strength, as well as some of the asset managers. But I think now that the banks are starting to perform a bit better, and the insurance sector, particularly the life cos, I think are doing well. I think the key risk here is that you may see a flow of funds out of some of these other subsectors that have done well back into to banks and life cos, and so we've been positioning the portfolio to try and benefit from that.
Fantastic. Thank you, Mike. Just thrown up a list of our ETFs and split share corps that you can choose to invest along with Mike and Eric, if what you hear today sounds good to you. For the preferred share side, which are managed by Eric and his team, investment grade U.S. preferreds through BPRF and BEPR. The first one is a straight portfolio actively managed by Eric and team of U.S. preferred shares. The second one gives a leveraged exposure, so a little bit of enhancement there. Mike is the lead portfolio manager on BFIN, Brompton North America Financials Dividend ETF, which is an equity cover call focused strategy. Mike and his team select stocks, and they also select their points to write cover calls to enhance income and to reduce volatility. And then finally, we have a suite of split share corporations. You can get leveraged exposure to financials through SBC, Brompton Split Bank, LCS, Brompton Life Co. Split, and LBS Life and Bank Split Corp. All of these ETFs and closed-end fund units are listed on the Toronto Stock Exchange. And so just with that, let's check for some Q&A here. I have a first question for either of you, if you'd like to take it, is just that in terms of equities, financials have rallied a little bit more strongly than the broad index since lows in October. both in Canada and the US. And so, is it too late to make a new investment? Where are we in terms of the cycle?
Yeah, maybe since questions focus on equities, I can take that, Chris. I think if we step back and look at the big picture, there, if a couple of months ago, you looked at the banks, and I think a lot of the factors were negative. I think those factors, as I mentioned in the presentation, are starting to turn more positive. Notably, the economy, I think, in particular, has continued to outperform almost everyone's expectations in terms of growth. And so I think as this soft landing scenario continues to develop, I think that's obviously very positive for the banks. And one analogy I like to look at, I mean, it's a sample size of one, so take it with a grain of salt. But one analogy I like to look at is the mid 90s, where you had a pretty aggressive tightening cycle in 1994. And then when the Fed stopped hiking rates in Q1 of 1995, the banks and the broader financial sector really outperformed over the next couple of years. Like the financial sector on an absolute basis more than doubled in the 2 years after that. Now, I'm not saying that we're going to repeat that here, but if you look at sort of where we've come from since the Fed last hiked rates in the middle of last year, we're only up about 10%. And so I think there's potentially a lot more to go, with the caveat that things can always change, if we do end up in a more negative scenario for the economy.
Okay. How about you, Eric? Early innings, late innings? Where do we stand?
No, I think we're definitely in agreement with Mike. I think particularly in the U.S., you look at the difference between GSIBs and regional bank and community bank performance. I do think that relieving some of the pressure on the banking system, both through lower interest rates, which we've already seen, and we might be seeing some additional ones, along with a strong economy. A lot of the regional bank stocks are still, 40-50% lower than they were 3 years ago. So there's definitely tailwinds there. I think the trick right now, what the Fed and other regulators are trying to figure out really is that balance between economic growth and or slowdown versus the interest rate picture. As of right now, it looks like the economy is very strong, balance sheets are very strong, and we're going to see some cuts in interest rates. That would definitely be a tailwind. But to Mike's point, if we see an economic slowdown, we see consumer balance sheets start to weaken, job losses start to pick up, obviously those things play through the sector. My only comment on all that is that I think banks, broadly speaking, have been preparing for that slowdown for years. They've been adding provisions, they've been adding capital. It will be, potentially an earnings drag when it comes, but they're not behind the curve. I think they've actually been out ahead of it, and probably, it's kind of the recession that hasn't shown up yet and may not show up. And I think banks are coming at it from that angle. So that gives us a lot of comfort that banks are conservative in effect, right? They've been provisioning conservatively, and they're not going to be surprised if loan losses start to tick up, as we kind of all expect will happen if the economy slows down. So I think they're pretty well prepared for whatever's coming. The tailwind will be a nice surprise because they probably over provisioned. And if we do end up with some economic recession or slowdown, I think they're well prepared for that.
Okay, great to hear. Just as we're continuing through our Q&A, I'll just throw up our sales team. If you think of a question after this webinar, please reach out to your sales coverage. Mike, this one's for you because it's a specifically Canadian issue. A lot of popularity in the HISA ETF products. In the last couple of years, they've gathered quite a lot of AUM. There's been some changes lately in terms of how regulators regard these types of deposit products. Could you just give an overview of just what these ETFs are exactly and what's changed recently? What's going to be the impact?
Yeah, so it's essentially like his high interest savings account ETFs. Essentially, it's a way for individual consumers to get institutional pricing on their deposits. So rather than placing a deposit with a bank here in Canada and getting something, if you do a GIC or potentially like direct access to a high interest savings account, maybe you can get something in the 3.5% to 4% range. you could buy one of these cash ETFs and get something in the 5 to 5.5% range, which is more institutional pricing. Now, what's happened is like initially liquidity rules coming out of OSFI like initially treated those as it was essentially consumer deposits, which get advantage liquidity treatment because those consumer deposits tend to be stickier. OSFI looked at it and essentially said, no, these are more like, should be treated more like a business or institutional deposit. And so essentially changed the liquidity requirements. It's actually coming into effect as of tomorrow, January 31st. And so we've seen some estimates out there suggesting that rates on these products will drop maybe in the 50 basis point range. And so that's how banks are responding to that regulatory change there.
Gotcha. So a little less out of those HISA ETFs. Okay, thank you for that overview. I've got one last question here, and I'm going to give this one to you, Eric. Private credit, rapidly growing asset class in the U.S. It looks, I guess, if you could take the view that it's been sort of disintermediating banks, or maybe this is investors stepping in where banks aren't covering. But can you just comment on this development and just how this is affecting bank quality in the U.S.?
Yeah, sure. The banking system, financial system is very large. To me, there's room for all these players. I think in a lot of cases they're complementary. Of course, the base argument is, it is disintermediation. Banks are going to be less relevant. It's all going to go to private credit. The reality is the size of the market isn't going to allow that to happen anytime soon, at least. And I think the reality is private credit and banks and insurance companies, all lenders are out there trying to make a profitable business out of whatever their lending niche is. And it has really kind of been that for private credit as well. In many cases, it's been complementary in the sense that if banks are trying to shrink their loan portfolios, private credit might be a source of an outlet for them to do that, to be selling portfolios. But it also could go the other direction. Private credit also isn't always in the growth mode. And as they're trying to manage the risks on their balance sheet, it's an additional counterparty out there to help to offset some risk or hedge some risk or gain some risk, depending on what you're looking for. So I honestly, we don't think it's really had a big impact. It probably has a bigger impact on the broader capital markets, where perhaps notably in the high yield space, you might find some high yield issuers not hitting the capital markets because they think they can get better terms or better covenants in the private credit space, for example. So it's just kind of all over the map, but the financial system is very much large enough for all of these players, and I think they're much more complementary than not. It definitely has not degraded the value of the banking system. It hasn't downgraded their portfolios at all. It hasn't caused them to necessarily take on risks that they shouldn't be taking. At the end of the day, you want all lenders to be disciplined on their underwriting process, and as long as banks remain disciplined, even when they're in competition with private credit, that's really what matters to us, is that they're not taking on outsized risk just for the sake of growth and market share, but that they're thinking about every loan and underwriting it properly. And as long as that's going to be the case, I think you'll see this is just one more segment. It's just like securitization in the market, right? It's just another way to diversify risk and maybe offload some risk from the balance sheet. And I think it's all healthy as part of the capital markets, just broadly speaking.
Okay, fantastic, Eric. On that note, let's wrap up today's panel discussion. Great overview from both you gentlemen, and I thank you very much for your time today. Thank you as well for joining, and please don't forget to reach out to your sales coverage if you have anything further for Mike or Eric, or you can call me directly if there's something you'd like to ask. And our investor relations line 1-866-642-6001 is also open to take your calls. One more time, thank you for joining us today, and have a great afternoon.